Sorry. Good morning, friends. Today we have two stocks in news. One is an update from one of the broking house experts. Nuoma has given a buy call for Reliance Industries with a target of about 1801. And the second stock that we would discuss is NCC Limited. So, Reliance continues to strengthen leadership across business verticals, including energy, retail, telecom, and renewables. Companies witnessing renewed investor confidence driven by operation resilience, strategic growth in solar value chain, improving sector dynamics, positive brokerage commentary, and expansion into high potential segments further reinforce its long term growth and narrative and market position. The shares of Reliance Industries Ltd has surged about 31% over the last 3 months, driven by strong operational excellence performance, favorable sector trends, optimistic around telecom, ARM, Geo. Recent tariff hikes are set to enhance Geo's margin and profitability with the ongoing 5G rollout and monetization plans. Analysts expect further upside, reinforcing Reliance's growth trajectory across its business segments. Secondary showing signs of recovery. Reliance Retail with the projected revenue and EBITDA growth of 15 to 18% in FY26 by store expansion and rebound in consumption. Sorry. The company's oil to chemical segment is witnessing a recovery supported by improved refining margins and performance, contributing to stronger earnings and boosting overall investor confidence. Nuvama Institutional Equities are one of the well-known brokerages in India, giving a buy rating and raised its targets on this stock with a target price of 1,801, indicating a potential upside of 18% from the Tuesday price of 1,528. Has started external solar module sales, potentially boosting profits by 6% and unlocking significant value upside. Reliance 20 gigawatt fully integrated solar equipment facility holds significant potential value. Reliance is poised to strong renewable growth. NCC receives 1,690 crore order from the state government and other institutions. The stock has gained 3% value yesterday, a leading infrastructure company in the back of spotlight announcing a fresh order worth 1,690 crores in June 2025 under the buildings division. The stock jumped nearly 3% after the information filing was shared with the exchanges, bringing investor attention to its growth, order book, and potential upside. The job durations range from 4 to 24 months, further strengthening NCC's order book and execution visibility for the coming quarters. NCC closed the year with an all-time high order book of 71,568 crores, up 18%. FY25 was the second record year. NCC logged its highest ever annual order inflow of 32,888 crores. For FY26, management guides 22 to 25,000 crore of fresh orders, riding on healthy sector demand and a strong bid pipeline. Revenue is expected to grow around 10% year on year. Important disclaimer: this article cum information has been extracted from the different resources on the internet. All the investment opinions and recommendations are solely those of the respective experts and rating agencies. These views do not reflect any personal opinion or advice. Stock market investments carry inherent risk of financial loss. Investors must exercise their own judgment and conduct proper due diligence. The author bears no responsibility for any losses resulting from the decisions based made on this article. It is strongly recommended to consult a qualified financial advisor or expert before making any investment decisions. Uh, Let us look at one second. Let us look at Reliance Industries. This is the current price. About 3% gain, 7% gain in the last 1 month. We'll quickly look at the financials. 20,000, 20 lakh crore market cap, price to earnings ratio of 30, which is good. Maybe little slightly higher than the uh, comfort of uh, customers and shareholders. Book value is 623, so company is trading at about 2.7 times its book value. Then return on equity 8.5%, return on capital employed 9.5%, 30.33% dividend payout, delivered poor sales growth of 10% in the last 5 years. Company has a low return on equity of 9% in the last 3 years. Dividend payout has been low at 10% in the last 3 years. You can see there has been an increase in overall sales from 239,000 crores to 261,000 crores. So about 10% or 9% revenue growth. Then profit growth. There has been slight increase in profit growth from quarter to quarter, so that is a good sign for the company. Overall, you can see net profit in the last 1 year has grown by about 2000 crores. For a big company, it may not sound too much of net profit growth. However, you can see sales have grown by 7%, stock price minus of 2%, and the return on equity of 9% in the last 10 years, which has been very consistent throughout. So, overall, a great performance in terms of managing the revenue and keeping a consistent net profit growth as well to some extent, and return on equity being consistent is a very good sign for the company. So we look at NCC. I think it was NCC, right? The second company, yeah, NCC. So this is the current price. Minus 3.7% return, minus 18% return in the last 1 year. So a bit of concern for the PSU. So public-private partnership basis, EPC contracts and BOT projects, 14,265 crore cap, price of 227, price to earnings of 17.4, which is very good. 0.95% dividend payout, which also is very good. Return on capital employed 22%, return on equity of 11.7%, face value 2 rupees. So the company is doing well with the borrowed capital is able to generate a surplus return, which is a very good sign. Uh, Low return on equity of 11% in the last 3 years. Company's cost of borrowing is high. Healthy dividend payout of 19.6%. Good profit growth of 19% CAGR in the last 5 years. Here you can see about 16% revenue growth. Then you can see about 20% net profit growth between June and March. And overall, you can see 10% revenue growth in the whole year. Then about 20%, 80, 17%, 16% net profit growth in the last 1 year. So this is showing as 12. But when I calculate, it seems to be more. But it's fine. We'll take 12% as suggested here. Then uh, compounded sales growth is 7% gain, minus 30% in the stock value, 12% return on equity, the best in the last year, and lowest being 8% in the last 10 years. Borrowings have drastically increased in the last 1 year from 980 crores to 1595 crores, which would ultimately lead to an increase in the interest payments and impact the overall profitability of the company. Reserves have grown by about 670 crores, which is a good sign. rest, friends. Thank you for watching the video today. This is all for today. We'll connect with another video tomorrow. Please share this video with your friends, family, and associates so that they could also benefit from this information. Thank you.